everyone. We are back to another edition of the Home Run podcast. I'm your host, Alex Sendek, and today is September 3rd, 2025. I say back because we've been hustling and closing a whole lot of loans this summer, which has been a wonderful and refreshing experience. Industry insiders, if you know, you know. And I do say we as well, as we're changing things up a bit this episode. I have with us three of some of our best and brightest loan officers here at Beeline. Chelsea Herkert, Makalee Bethard, and Rob Floyd have all taken the time to join me today, and it is very much appreciated. Folks, welcome to the pod.
Hello.
Hey, good afternoon.
Thank you.
Now, as we get started here, I think it's important to say that as all of us collectively kind of have extensive experience in the specific market, there's kind of a few main points of emphasis in lending in general that we see clients struggling with on a regular basis. And I just think today it would be nice to kind of have an open forum here to bring up some of those specific items to gather a better understanding and hopefully connect a few dots for our listeners out there. So as this is more of a roundtable discussion, Rob, Makalee, Chelsea, feel free to add on or intervene at any point, but I will ask one of you to answer a specific question and then we can kind of just add on from there. So the first topic of the day is a favorite of mine to talk about. As we all know, Beeline has a major point of emphasis on all things investment, especially when it comes to our financing preference, of course. Non-QM and specifically DSCR loans are quite a bit different than more of our traditional loan programs like conventional, FHA, and VA, as we all know. But the biggest thing for me, I see a lot of folks questioning a lot of the time and really just kind of have a lot of negative connotations that I find interesting and frankly misleading, prepayment penalties, right? So Makalee, let me start with you. Can you please just expand a little bit on what a prepayment penalty is at just a base 101 level, and then we can kind of just level up from there.
Yeah, I mean, a prepayment penalty is exactly what it sounds like. If you pay the loan off in full or sell the property within a certain period of time, there is a penalty that tacks on to the payoff of the property. Yep. So it's very, very simple.
And kind of from an investor standpoint, I mean, yeah, that's definitely what it is. But what are the kind of the pros and cons, would you say, for a prepayment penalty? Like just start there.
Yeah, I mean, obviously pros with prepayment penalties, if you're an investor who is planning on holding this property long term, it does provide rate alleviation when you're obtaining the property or refinancing the property. So therefore, it's going to increase the monthly cash flow for you if you're planning on holding the property long term, where it's not something that's going to affect you. And it's obviously going to allow you to save on interest annually when you're going to be obtaining a lower interest rate from it.
Right. Now, I mean, I've seen folks go a lot of different directions in that. I would say a lot of folks just right off the bat are kind of like, ew, I don't want anything to do with the prepayment penalty. I yuck. And it's almost like an immediate turn off. And I think so much of that kind of stems from the previous mortgage crisis where there were negative products or negative features on loans that really weren't disclosed. Maybe people didn't have a full understanding, and now we're kind of in a situation where clients are just so standoffish, right? Just right off the bat about that prepayment penalty. So what I want folks to really understand here is just what Makalee said. We can leverage the prepayment penalty to your long or short-term goals with the property to make your interest rate work for you. That's all that's happening right there. We're not, there's no negative features. As long as you're understanding what's happening, I think a prepayment penalty is a great idea. And then now, Chelsea, I'll go to you real quick. Just maybe expand a little bit more on what Makalee was saying. What situation would no or a low prepayment penalty make sense versus a lengthy prepayment penalty? How long can I go on a prepayment penalty for starters?
Yeah, I think most of the time 5 years is going to be the maximum. Right. So a lot of people hear 5-year prepayment penalty and their first thought is, well, what happens at the end of 5? Because of, like you said, in the 08 sort of game, a lot of people think, 5-year prepayment penalty means at the end of 5 years, there's a balloon, or at the end of 5 years, the loan changes. That's not at all part of the loan. And that is sort of part of the first thing people fear. It's just if you select a 5-year prepay, after 5 years, the prepay completely falls off. Nothing else changes about the loan. There are some people, if let's say, I had a guy say the other day, well, listen, 5 years ago, we were in COVID, and it stuck with me. 5 years ago feels like a lifetime ago, right? We're so far out of COVID. So if you have an investor that sort of thinks like that, hey, I may want to sell in 3 years, or I may want to do whatever, you look at what the prepayment penalty would be. If it's, if the maximum is always 5%, if it's a lower loan amount, you wouldn't be selling unless you got some amazing offer. So you take the 5-year, you take the hit when you sell it. Or if listen, in 3 years, I'm getting out of the investment game, I'm going to sell everything I have and move to wherever. Then you can go with the 3-year. And although the shorter the prepayment penalty, the higher the rate, it's not something that's out of this world. Usually to go from 5 to 3, you're looking at, an eighth, say 0.125 to 0.25, 0.375 at the most. And if it's a situation where your tenant's paying the mortgage, if it saves you 10, 20, 30 grand when you're selling, you just have to look at all the options and go with what you like. Not every investor has the same long-term goals. And then some states, you can't have one.
Yeah.
So the first thing people do is they either go, oh, well, my rate's so much higher. It's good and bad. Your state doesn't allow it. So guess what? In a year, if you're sure rates are going to come down, we can refinance it for you. So either way, it's not a horrible thing to take it. It's not a horrible thing if you can't have one, either side.
I think that's exactly the right sentiment. Makalee, what's going on?
Yeah, I think a lot of people have this fear of prepayment penalties because they're used to standard conventional Fannie Mae and Freddie Mac type loans where they may have experienced, mortgage insurance in the past, and they just kind of think the two are the same, and they're simply not. So it's not scary, and it literally just falls off. And I think another thing people fear on prepayment penalties is it's going to be like some bill in the mail that they have to pay up front or out of pocket. And so resting your investors assured that, you can still pay over and above an additional, the principal, up to 20% in a calendar year most of the time. So you can pay the loan down faster if the property cash flows and you want to do it that way. Or if we're going to be refinancing because the rates plummet, when they do, not if they do, then we're just going to roll that prepayment penalty. If we do it, we're going to roll it into the new loan amount. Or when you sell it, it just gets added on to your payoff. So it's not something that they're going to be experiencing out of pocket. It's just going to get rolled in, and it's not something that they're ever going to see versus the benefit right now of having that lower interest rate.
Love that feedback as well. And I think just adding to that, it's again, just talking a little bit about pricing. And Rob, I'm going to loop you in here. I know that I want you to talk to me about the mandatory nature of prepayment penalties, if they are or not, but more so, I know that you've had a couple clients where maybe they've gone with a 5-year penalty and they found that the pricing was actually better than conventional pricing in some scenarios. And Rob, I don't know if you want to talk a little bit about that.
Yeah, absolutely. So prepayment penalties are absolutely not mandatory. Some states don't even allow them. There's some states like Ohio where you've got to have a certain loan threshold. Other states like Illinois, for example, or Pennsylvania, where a loan has to close in an LLC in order to be eligible for that prepayment penalty. But yeah, like Alex said, I've absolutely found a lot of scenarios where, maybe not going all the way to 5, meeting in the middle at the 3-year prepay is a sweet spot where you're going to get, assuming excellent credit and, pretty decent loan to value ratios, you're going to get a loan rate that is pretty on close to parity with conventional loans. 3 years, I typically find is kind of that spot where I like to jump off from. 5 years seems like a long time. As Chelsea and Makalee have said, 5 years ago, we were in the midst of COVID, right? 5 years, when I look at that, that's what you're going to have a car payment for. That's a long time to lock yourself in to potentially not selling or refinancing the property if, there's a big shift in the market or you get a great offer. Now, with the prepayment penalty, you're not really ever in a spot where if you sell the home, you're not going to get any equity. You're still going to walk away with a good chunk of change, right? If you do need to refinance it for whatever reason during that period, most of the time that penalty can be rolled into the cost of the loan. But going for that lower rate, I've found that typically the difference between 3 and 5 is, it's going to be the same between 1 and 3 and 3 and 5, but going to that 3-year is a nice spot to meet in the middle, get yourself in a great cash flow situation, have that lower rate. Rates right now, seeing some of the lowest rates I've ever seen with DSCR.
Yeah.
Seeing some rates that are, where people were buying conventional properties for primary, just a year or two ago. So definitely something that's worth the consideration. But at the end of the day, it really just comes down to what your plans are for the property, right? If this is a quick offload, obviously a 5-year is not going to make sense. So just having that conversation and finding that sweet spot is something that, I think is always beneficial for every borrower.
Definitely agree. And I think that's really the last point we need to make with prepayment penalties. Again, talk to your loan officer, make sure you're comfortable and with your business partner, et cetera, on what your long or short-term goals are with the property. And the only thing I will add as well, I agree. I think 3-year is probably the most common prepayment penalty type that I see our clients going with. But with the 5-year, the one thing I will say on the 5-year, if you happen to be investing in a state that's a higher closing cost state, and when I'm talking about higher closing costs, I'm thinking title fees. So if you're a person in investing in Florida, investing in Texas, where each financing transaction costs X amount, no matter what, because of those title recording fees, sometimes taking that 5-year, getting the lowest possible rate you can and just kind of setting and forgetting is a great option if you decide that to be a longer term hold for you. That's the only other pro I'd go with a 5-year. Go ahead.
Just one other thing to consider too is, you are looking into DSCR loans and shopping different lenders. A lot of lenders will automatically go to a 5-year prepay on an initial offer, especially because that is going to be the most attractive interest rate, right? So they want to get you in with that super low rate. Hey, this is what we can offer, but you got to, read that fine print. Make sure, if you are looking for a 1-year prepay, you don't want to get an offer for a 5-year prepay because those numbers are going to be very different at the end of the day.
Excellent point. Not all lenders are created equally. Us loan officers at Beeline Loans think about our customers first and foremost before we price you out. We're talking everything about your prepayment penalty. It's a big point of emphasis for us to make sure we understand exactly what you're getting into, and that we're tailoring a loan for you that actually makes sense. We're not out here peddling lowest rate. We have great pricing, but we are also here to make sure we're crafting a sensible product for each client. So I think that's an awesome point. Okay, well, great. I think that really clears up a lot of questions about prepayment penalty. And so I guess we'll roll on to the next topic, which is probably my favorite topic to discuss, to be honest. So often we have customers coming to us and without really even asking or having a chance to discuss their loan scenario or their goals, right away, they want the best rate with 0 points or 0 closing costs, right? That's just it. No further discussion. If you even try, they're off the phone, they're gone. Listen, rates matter, and so do your costs. And I think I can talk about this matter all day again. So before I do, I'm just going to go back to Rob Floyd right off the bat. This question goes to you. A lot of people ask for quotes immediately without points, as I said. Is that thinking flawed?
5 years ago, maybe not, right? But that I think is a proper or a holdover from COVID, when you could just go in and say, hey, I want to essentially just get everything covered by lender credit. That's not the case today. If you're looking for something that is going to be the most competitive thing on the market, as loan officers, we've had to pivot in order to survive. And over the last couple of years, points has definitely been something that is essentially essential, to our loans. And so, looking at points options, at the end of the day, it comes back just like the prepayment penalty. It comes back to your plans for the property. If this is a property that you're going to hold, points is definitely something to consider. right now, the timing of the market is such that, maybe buying something that is multiple points isn't going to be beneficial if you're that type of borrower who is always looking to get yourself in that lower interest rate scenario. If you're more of a set it and forget it, yeah, absolutely. Pay a little bit extra now to have that lower payment each month. So that's something that you definitely want to dive into, see the numbers for your specific scenario. But points are always a great idea, in my opinion. I don't know if anybody else would chime in on that.
Almost. I agree with you. I agree with you completely. I think points are something that you have to just look at it. Each scenario is going to be unique. To speak a little bit more on it, right? And I'm gonna go with Chelsea for a sec here. Explain a scenario, if you could, where you've seen a client pay a lot of points or a client that has taken a large amount of lender credit gone the opposite direction. Like, what specifically are they shooting for there when they're actually having a thought out, reasonable plan for it, right? And not just saying, I want the lowest rate or I want the lowest cost. Yeah.
That's the biggest part of it, is having an actual plan, not just texting or emailing 100 lenders and saying, send me your best offer. Because I'm always like, what's best? What is your best? Is best no cost, lowest rate? I mean, there's best is so all over the place. So actually having a plan. And I think, for me, and most of the time, I'm referring to investment properties. I think each investor has a different end game. I have some investors that 100% want to see 4 or 5 different rates. The most expensive, which is going to be the lowest rate, the highest rate, least expensive. And there's a happy medium in there. The rate with $10,000 in points may not be worth it in the end, right? So figuring out what that payback is, right? When have you sort of made that money back is really important on the investment side, right? On the primary residence side, I think it's different. I think for a primary residence, it should be more what you're comfortable with, what you want your payment to be, because you're the one making the payment, versus an investment property where the tenant is making it. So, exactly how you opened up the question, having a game plan, doing the calculations, and figuring out what works, not just, I want the least cost or I want the lowest rate. And then you're like, well, the lowest rate has 20 grand in points. So you got to figure out what it is that you're asking for.
That's right. Absolutely. Makalee, I think you had a point you wanted to make.
Yeah, I think the points is just a sensitive topic for whether you're an investor, primary residence, it doesn't matter. But I think it just comes down to the lack of education. From COVID, it wasn't a conversation that they had with their loan officers at that time because there wasn't a need for it. And you're not going to remember every refinance because it's not something that people do. Average person refinances like every 5 to 7 years. Well, we don't remember those fine details 5-7 years ago. It's hard to believe that COVID was 5 years ago. Like Chelsea said, it feels like a lifetime ago. So I feel like a lot of people just don't have the education. And like you mentioned, like we pride ourselves on educating our borrowers on everything. So like I think that's what's important, is that the people understand what is a break-even point and does that fit into their goals, regardless of what type of loan product they're seeking. There's always a break-even point anywhere. And so it's just about educating them that there's a break-even point on saving on the annual interest of the loan and your monthly payment. So it's multifaceted when you're making that decision for them to say, okay, that makes sense to me, or no, that's not right for me, now that you've explained it to me. I think that's the biggest why people are so scared of points. They just don't have the education behind it.
I think there's a lot of truth to that.
And going on that education part, the break-even calculation is not some crazy Y equals MX plus B where we got to break out the abacus, right?
Right.
You tack on what the additional closing cost is, you divide that by what the monthly savings is, right? So it's a very quick calculation that I'm doing this on the phone as I'm talking to a borrower. Hey, well, you could put an extra $5,000 in to save, $43 a month. Does that make sense when it comes out to, hey, that's going to break even over the course of the next 5 years, right? So goes back to set it and forget it versus looking for that best deal. I have no idea if that math is correct. I was just kind of spitballing there. So somebody double check me, leave it in the comments or the review. Hey, that loan officer doesn't know any math, but that's the basic idea, right? It's something you can do super quickly, and that just goes right back to the education.
It does. It's exactly right. I don't know what your math is. I was in my head thinking, if I'm going to invest 3,000 in points, it's going to save me $70 a month on my payment. You're going to be looking at 3.5 year break even. For me, I instruct my client, again, it depends on their longer or shorter term goals. If they're not sure how long they're going to hold that property, I usually say anything below 5 years for a break even probably makes sense. But the lower, the better, obviously. So 3.5 would be a deal that I would say, would make a lot of sense. So, and when I say 3.5 years, what I'm saying is you're going to be holding that loan for 3.5 years with that lower rate to recoup on your investment of $3,000 in this scenario, right? After that, you're banking basically $70 a month in the black, right? So that's the way you want to look at it. Now, a high level investor might say, I have a 3.5 year break even. I have a 5 year prepayment penalty. I know I can't get rid of this loan for 5 years. Maybe I should invest in points to where that break even is going to take around that time or less, right? Because I know I can't get rid of that loan. So why not invest in points during that time frame and make myself a little bit of money, right? So that's another great reason. Yep, go ahead, Chelsea.
I think people also need to understand that we are not that there's anything wrong with used car salesmen, but that's sort of the attitude you get with people when you're trying to explain something. Trust your loan officer. Yes, there are awful ones out there that are not going to be great, right? But most of the time, we're really just trying to educate you and show you what makes sense and what doesn't. And there are people that if you're going through these calculations with them and you can just hear it, they're not believing anything you say. Well, one, it's math. So you don't believe or disbelieve math. It's numbers. I know everyone does all their own research now and, that equals right. But math is math, right? So trusting that if they're explaining something to you, don't be afraid to ask again. Don't be afraid to ask about the calculations. Because it doesn't matter how experienced of an investor you are, your loan officer has probably closed more loans than you do. Your 20 properties that you own, your loan officer may close 20 in 1 month or 2 months. So
right,
give them a chance to help you instead of just assuming they're trying to hide something from you.
I do feel like there's a reason for folks to have some skepticism. I can see why, if I can be a little paranoid myself, but I think it's important to know, listen, and I think, I'm not just with Beeline, but I think with pretty much every lender out there these days, we don't get paid on what rate you have. We get paid on closed loans, right? So whether you're getting an 8% or a 3%, that does not impact anybody over here on comp, right? So that really disarms anybody to like spleed you into any type of direction. It truly is, we want to do right by our customers. We want to do repeat business. We want to build investor relationships. So there's no reason for us to be leading you astray in any type of way. So we've talked about points quite a bit. Again, there's kind of two ways to go about it. You can also go the opposite direction and go higher on rate and take a bunch of lender credit to offset your closing costs. Makalee, have you ever seen a client do that before? Why would they do something like that?
In this market, it's not as common, but I would say it makes more sense for them to do it one of two ways. Obviously, when it comes into a purchase, offsetting that closing cost if maybe funds are tight for the down payment. So we may want to kind of offset and handle that piece of it if there's no seller concessions or anything like that to help offset that. Or if maybe we're going more rate and term refinance and we're close to that max 80% loan to value with excellent credit, we may need to use a little bit of a higher rate. So you may not have to bring money to the closing table or something like that. Type of idea would make sense. But again, it's not something that's super common right now to do.
No, not super common. I've also seen it where maybe they were really unsure. Hey, maybe I'm a veteran and I might be getting work orders soon, or maybe I have a job where I'm going to be transferring or something, and they want to take the highest rate possible with the lowest cost so that if something happens where they either need to sell or refinance, they're not out in closing costs that they paid for up front. Right. So it's kind of like, I don't want to double dip. I don't want to be in a position where I paid closing costs and then 18 months later I'm paying closing costs again. So if you're that type of person, I know it doesn't get talked about a lot, but it really is. It's a pretty smart thing to do if that falls in your scenario. Right. So again, I just want folks to start thinking outside the box a little bit more when we're talking about pricing. And then how important it really is to have loan officers to be your advocate and not just spitting out rates. Speaking with when we're talking about rates and again between points and lender credit, et cetera, Chelsea, how can I kind of truly tell between lender A and lender B if I'm trying to compare apples to apples? Maybe one guy is telling me he's got a 6.5. The other guy's telling me I got a 7. What am I even kind of looking at on these quotes to compare? What help me kind of sift through that mess?
This is the hardest conversation to have with people that aren't familiar with the process, especially, I can speak for us and at Beeline. We do care so much. We do know we have great products. We do know that we have the best team. So sometimes when you know that someone is maybe being lied to or led astray, it's a very difficult conversation to have. But the only thing you should really be comparing is Section A from your loan estimate, because I don't care if everything else, if I'm comparing lender A and lender B, if every other fee is different, every title fee is different, every attorney fee is different, all that is going to be the same in the end. You're going to pick a title company. That's who you're going to use. It's going to be that's what you're using, right? It's going to be that fee, regardless of what the loan estimate says. So that Section A is the only thing that's going to change. So the best way to compare is to get a loan estimate from anyone you're comparing at the same rate. Because if you're comparing, well, this guy has a 6.5 and this one has a 6.3. Okay, well, great. We can all offer the same rates. It's what we're charging for that rate is the only difference.
Yep. And I always suggest, if you are shopping, get those estimates, those loan estimates, ideally loan estimates, or get all of the offers as closely together as you possibly can. Sit down on Tuesday morning and from 10 to 11, you're getting offers A, B, C, D. Because if I give you something that on Monday morning and you go and talk to another guy on Thursday, well, my offer's changed as well, right? So you got to make sure you're getting them basically rapid fire. Set those appointment times up with the prospective lenders, or say, hey, can you get me something, first thing Tuesday morning, whatever it may be. Just making sure that you can have that apples to apples comparison, and definitely, make sure everybody's got the same information as well, right? Because one thing that, like Chelsea said, the most important thing is Section A, which is on page 2, top left corner on that loan estimate. But before we even get to page 2, if I've got your taxes and insurance at $450 a month and the other guy has them at $200 a month, obviously my payment is not going to look as attractive, right? So you got to make sure that everybody is on the same playing field in order to give you that best comparison.
Don't forget, if you happen to have somebody where you've been able to pull their credit and their credit's 720 and they've been walking around telling everybody in town that their credit score is 780, well, that's another that's another issue as well. So make sure everybody knows your information, because I promise you, if you're telling them 780 and they price you and you get your credit pulled at 720, you're about to have a rude awakening come lock-in time. So make sure everybody's aware. We want to make sure, you're giving yourself the best chance moving forward to get the best deal. Okay, so last topic of the day. We have a program over here at Beeline that I don't believe we talked about at all on this podcast. Maybe Chelsea and I touched on it once in a previous episode.
Exciting.
Yeah, but it's one of our favorite loans. It's the bank statement program, right? I bring this one up, not necessarily that there are a ton of questions on it, just more so that I think folks still seem to not be overly aware of the program in general, that it even exists, the pros and cons, how's it work. For some folks, we've actually heard some truly remarkable testimony. Check out our Beeline website as to how it kind of reshaped their lives for the better. Chelsea, I know you love the program. Please provide a brief overview on just what the program is and who's it for, what's it do, that kind of thing.
Yeah, so it's for self-employed borrowers, period. That's a misconception. I have W-2 employees ask me if we can use a bank statement. You have to be self-employed. And it uses your business deposits as income. And then a small expense factor is assigned based on the business type. So people always ask, if I send you my bank statements, you're going to see all my expenditures. We're not looking at that. When we calculate what your expense factor is, it's based on the business type. So it's typically 12 months. They add up the deposits, assign an expense factor, and that becomes your monthly income, as opposed to tax returns where we're going to see all the write-offs and everything else. So we've had, I know all three of us have had borrowers that 100% couldn't get a $25 loan using a conventional loan. And then we get bank statements and they get 50, 60 grand a month in I got one guy right now, $53,000 a month in income. We could not get him a $100,000 loan with tax returns.
Yeah, absolutely. And another misconception that I see, especially on the borrower side, is, we're looking at the revenue of the business, right? That balance is not really that important. One example that I always go back to is a loan I had, a couple years ago, where I remember looking at one of the statements and the ending balance was like 6 cents, right? He moved everything out of the balance of that account each month, but the revenue generated had an income of like 100 grand a month, right? So just because you're not keeping money in those accounts does not mean it's not something that we can, qualify off of. That is one thing that I find very useful to folks. And it doesn't necessarily have to be business statements. That is the ideal. That's going to be the standard, but there are situations where personal statements can be used. Yes, you still need to be self-employed, but personal statements is an option as well if necessary.
Absolutely. Makalee?
Yeah, one, important piece with bank statement loans to remember is you still do have to have a history of being self-employed. You can't be self-employed starting in January 2025. Like, you still have to have a 2-year history of being self-employed. But, a lot of companies don't have, they're startups, they're just getting off the ground and may not have a whole lot of revenue in the first 12 months. Well, if you've been self-employed for 2 years, we can still just do a 12-month bank statement. If your income is really strong the last 12 months, but maybe not the last 24, may bring that income down to kind of adjust the ratios negatively for you. So we still have to see history of the self-employment, but we can do 12-month statements. And doesn't have to be necessarily the same company, has to exist for 2 years, but you do have to have self-employment history of 2 years to utilize this program.
Yep. Keep those tax returns in the filing cabinet because we don't even want to see them.
You don't want to
Just
see
those business
now,
bank
if you got
statements.
like a pension or something too, like, don't forget, like, if I've been self-employed for 2 years, but I get Social Security income, I get a pension, we can use that on the loan application as well. I believe if you have a co-borrower that maybe makes a W-2, I believe you can use that even as well. Just somebody has to be the main borrower. There has to be somebody that's been self-employed for 2 years to really do the bank statement program.
Yes, absolutely. Yeah, you can use W-2 income from a co-borrower. That's a-okay. There are some exceptions in place where, for example, I had a borrower who was a dentist. He's been a dentist for years. He just opened his own practice a little over a year ago. So he was not in that practice for 24 months, but he has the history in the same line of work. So we were able to qualify the income, right? So there are nuances. Just because you don't have that cookie cutter situation does not mean, you're not going to qualify. So having that conversation with the loan guide is extremely important, and being transparent with the loan guide is extremely important as well. Just from the loan guide transparency standpoint, I think one thing that is important for table setting expectations is, understand that there's a turn time, right? You're submitting 12 months of bank statements to us, and you have hundreds, if not thousands, of transactions in that bank statement. This isn't something that, hey, it is Saturday afternoon and I just saw this house and I need to put an offer in the next hour and a half. Don't come to me with that, because
That's right.
we want to have that pre-approval set up early. The bank statements typically take 24 to 48 hours to come back, but we need to be on the same page with that. It's not, hey, you sent me the bank statements, what's the income, right? There is a process that goes into that income calculation that, as long as everybody's on board, it is a smooth transaction. But that is part of, our job as the loan guide to set that expectation. And that's something that I definitely try to do. I'm sure all of you all try to do it very early with those bank statements as well.
Oh yeah. I mean, listen, I've in a perfect world, I'd like everybody to not ask me for a pre-approval on the weekend after they've seen a property. I would love everybody to get pre-approved first, as I'm sure every realtor and everybody in the industry would agree. We work with what we got, but I think on a bank statement loan, it's not one of those deals where it's like, oh, you're making me, come in the middle of a college football game to do your pre-approval. I can't give you a pre-approval that quickly on a bank statement loan. It takes some time. Part of the reason why it takes time is because of how the income calculations work, right? So we're averaging deposits, and depending on how your situation is set up, whether you're offering like a goods or a service, or if you have employees or what have you, there are expense factors that come into play with these bank statements as well. Now we at Beeline have a few options on how to handle these expense factors, right? Or kind of been able to give you a fair shake at what your true income is. So let's say we get a income calculation for a particular client. It came back lower than expected, and it's a 50% expense factor, but they're like, well, that's not accurate, right? That's not an accurate reflection of my true expenses. Makalee, what can we do in that situation? I know we have a few options, but what's the best one?
Yeah, the best one. So depending on the industry you're in, most of our investors kind of have categories for different industries and have kind of a set expense factor for that. But if it's, your company doesn't have 50% expense factor, you can have your CPA, tax preparer, IRS agent that you work with, and they can provide us a signed letter that states, hey, I do this XYZ business taxes based off of their expenses. Their expense factor ratio is 20%. And then we are able to use that letter and adjust the expense ratio to 20%, which then obviously would increase their monthly qualifying income to use.
Which
and
is awesome.
Typically 20% is the floor.
It's pretty awesome. I mean, that just gives you a lot of flexibility to really max out. Again, the income, what's happening here, guys, again, is what we're doing is we're taking the bank statement and we're just replacing that with your tax returns. Everything else is really the same, as far as mostly the same when it comes to debt to income ratio, down payment, that kind of thing. So all that's happening is the way we're calculating the debt to income ratio is the same. Where we're getting the number for the income is different, which is through the bank statements and throwing the tax returns away, right? Obviously, the main benefit there is we're getting the write-offs out of the equation. You're not deducting anything on your bank statements, right? So those deductions that are generally shorting your income to Uncle Sam is now out of the equation when it's coming to qualify for your house and to maximize how much house you can afford. So that's again the nature of the program, and I think we have kind of some life hacks here to really make that work best for you. What's going on, Rob?
Yeah, and one thing that I think is great about the bank statement loan program as well is, we get those statements, we get the income calculated up front, right? So we know, barring needing to get an updated statement because some time has elapsed, we know exactly what you're making each month, right? I've seen so many times where a borrower goes under contract on a property on a conventional, they're self-employed. Well, the loan officer had one calculation, the underwriter had a different calculation for income. And now all of a sudden their loan is getting denied, right? So they're having to scramble in that short period, a couple weeks, very stressful. Getting that income calculation up front, really alleviates a lot of that stress. We can all be on the same page from the start and, going back to managing the expectations, have that table set conversation from the start.
100%. Absolutely agree with that. Okay. Chelsea, I'm not going to hold you to it because we do have tons of different investors with tons of different parameters, but just real quick, just with purchases and refis on bank statement, how are they comparing with, your typical agency deals with like minimum down, minimum, your max cash out LTV, that kind of thing?
Yeah. So in general, you're going to be the minimum down payment for a bank statement loan is going to be a little bit higher than conventional. I mean, in most circumstances, you are going to have to put at least 10% down with some of the best credit. So yes, like anything, you may get a little bit lower than that, but you should expect for a minimum of 10% down. On a primary residence, obviously. Cash out, you're going to be maxed at 80%, which is not bad, right? And then a rate and term, or where you're refinancing without cash out, is going to be the same as that purchase, so 10% down. Obviously, the parameters with bank statement loans you're still calculating debt to income. Like we said in the past, it's income and then debt on credit. We're not looking at debt to income on the returns. But where conventional loans don't have set credit scores, this credit score gets you this. Conventional loans, typically, if your debt to income can handle it, you're good. I would say 99.999% of bank statement loans, your down payment or your cash out percentage is based on your credit score. So you're going to start with, 10% down at say 730, 740 and above. And then, right. And then as the credit decreases, your down payment's going to increase. So just keep that in mind. I mean, it does leave it open because, on some conventional options, you just can't get it approved, regardless of what the income is. Versus a bank statement loan, at least you're given that option. Hey, put more money down. We'll make this work.
And one cool thing about the bank statement is, if you do that 10% down payment, there's no PMI. So that's a big plus as well.
You read my mind, Rob.
That's right. So yeah, a lot of great reasons to use the bank statement loan program. And again, if you have, credit scores aside, if you have great credit, it's very similar to a lot of conventional deals, but still serves a great purpose. And just, I'll tell you how great of a purpose it is. I'll share a story here where I actually completed a bank statement loan. It was for a gentleman down in Florida. And the reason this is my favorite loan program is how emotional some folks get in a good way, right? Like this guy, he's been self-employed for 20 years. When I first talked to him, he was like, I don't even know why I put my information out here. There's no chance I'm going to get approved, blah, blah, blah. He wasn't aware of the bank statement loan program. Fast forward 30 days later, he got the keys to his first house. I think, he was like in tears basically, right? So that's when, we work hard in this industry and, there's certain transactions that make you really kind of enjoy your job, I guess, right? And those that client really made me happy. So I'm sure we all have a story like that. Feel free to share. Makalee, I think you had something you wanted to add. Go ahead.
Yeah, I just wanted to kind of reiterate that a bank statement loan is not just for you to buy your own house for your family. You can buy a primary residence with it, but if you want to, add and create a new venture and you want it to be in the real estate world, you can use your bank statement loan on an investment property. Now, the down payments are not going to be 10% on an investment property, but you can use it on, a vacation home, an investment property, your own home. So it's not just for your own consumer basis. It is a non-traditional loan, so you can use it on all avenues. You're not put in a box for one thing. So it's definitely another great resource to have.
Absolutely. And,
And
kind of specific, but, you can treat it almost like a DSCR loan
yep.
as well, in that you can close it in your LLC or your trust or whatever. If it is an investment property, now you can't do that on primary. Definitely want to make sure we're clear on that. But, running into scenarios where on paper, the DSCR isn't going to work because that ratio is not quite where it needs to be, even though the borrower knows that they can do XYZ to the property and make it work. Well, we can't approve on projected income,
Futures.
right? We got to approve on what we got, one in the hand, two in the bush sort of thing. So, that bank statement loan could open it up. You keep it in the LLC. There are options for prepayment penalty on those if you want to get that lower rate. So it is definitely an awesome program. Just got to be self-employed. 2
100%.
years.
And don't forget, you can use a prepayment penalty too if you're buying a bank statement loan or a business purpose bank statement loan, aka investment property, and you can use that prepayment penalty to leverage your rate just like you could DSCR too. Just can't do it on a primary, as that is a personal type transaction. So business purpose only. All right, cool. So I guess if anybody have any kind of last final parting thoughts here, I think we've had some great chatter on all three topics, but if anybody has anything kind of left, now is definitely the time.
Just pay your points for that prepayment penalty on the bank statement.
There you go. That sums it up. That sums it up.
All three, baby. Touched them all.
Well, folks, I believe that wraps us up for our episode today. Again, Makalee, Rob, Chelsea, thank you guys so much for coming on. For you listeners out there, be ready. We do have a lot more content in the works. Yes, leave your comments as well. For you coming up soon. We definitely can't wait for next time. But until then, be well. And thank you all again for your time.
Bye.
Later, guys.